Greetings class, and welcome back to this video covering cost, volume, profit relationships, chapter 5. Here are the learning objectives for the chapter, but I'm not really going to go through those right now. We've been through a lot of the cost, volume, profit analysis in class, but I want you to have this video if you need to go back and refer to any of this at a later date. So cost, volume, profit analysis basically allows managers to decide what products to offer, how much of it they have to sell, and examine the cost structure of those products and determine whether or not they remain profitable or not. So when we're looking at cost, volume, profit analysis, we're looking at the variable costs that we have in a product. And the variable costs are going to be raw materials, direct labor, variable overhead. And we're going to deduct those away from the selling price, the total selling price, and we're going to wind up with a contribution margin. So as we go through this, we'll talk more about that calculation. So when we talk about cost, volume, profit analysis, they give us this example here. When they're talking about this contribution income statement for Acoustic Concepts. Basically, they're selling speakers, and they have certain sales volume here identified, the per unit cost, and then they have variable costs associated with it in the contribution margin. So basically, when we're looking at cost, volume, profit analysis, we're looking at contribution margin and the relationship between that and fixed costs usually. So in this income statement, they sell one speaker, and you can clearly see they have a fairly significant loss. But if they sell, and what happens if they sell 350? Well, that's where they break even. And we can use a calculation to see what that break-even point should be. And we'll get to that here in a minute. So one of the things about cost, volume, profit analysis that it allows us to do is to do different scenarios of sales volumes to identify what the difference in costs will be and the difference in sales. So for example, here they have two different sales volumes side by side, and you can examine what happens to the variable expenses, the costs, and the income if they're selling these two different levels. Because we can do this, and the profit calculation is basically the profit is going to be equal to the price per unit times the quantity sold minus the variable cost per unit times the quantity sold, and that's going to be that minus fixed expenses is going to be the profit. Because of that, we can create a formula to calculate where we will need to break even, which is basically where we cover fixed expenses. Another way of rewriting this is to say that profit is equal to the unit contribution margin times the quantity sold minus fixed expenses. So we're not going to break out the variable cost or the price every time. We're just going to have a contribution margin, which is, the contribution margin is going to be what we've sold, the sales dollars minus variable costs. So when we look at cost, volume, profit relationships in graphic form, you're going to see a graph like this, where you have a line with a slope here, and this is going to be, the green line will be the expenses that we see, and generally these are going to be total expenses that include the fixed expenses here. Now you see the fixed expenses is a straight line. That means they're always going to be at this level no matter how many units we sell. However, these expenses are going to vary in relationship to the number of units sold. But you notice that no matter what we sell, we'll never drop below in expenses the fixed expense line. So the sales in number of units is going to be this slope, where we see, okay, if we hit at this level of sales, we're going to be covering our fixed expenses, and if we sell this level, we're going to break even. And at this level up here, where we're looking at right on this graph, we're going to make a profit. Now, that's just a graphical representation of what we're doing, and that's based on the volume of speakers that we're selling. So the volume is across the bottom here. So if we sell 350 units, we're going to break even right here. If we sell at 600 units, we're going to have this much profit here, which is the difference between these two. 150,000 and 125,000. 125 is the total expense because it includes the fixed expense down here. So our profit will be the 25,000 in that case. Okay, so when we look at this, this is exactly what we were talking about a moment ago. But you see the break-even point, 350 speakers right here. The loss area is anything below break-even. The profit area is anything above break-even. And you notice fixed expenses are a straight line across because we're never going to drop below those fixed expenses. And again, this graph here will show you the profit. Basically, this is just taking the difference between the sales and the total expenses and putting it in its own line on the graph. But basically what we're going to be interested in quite a bit here is the contribution margin in terms of per unit, which we can calculate here. We have a contribution margin per unit by taking the sales price per unit minus variable cost per unit. We get the difference. Or the contribution margin ratio, which is going to be the contribution margin we have, which is right here, 40,000, divided by sales of 100,000. So we have a contribution margin ratio for this product of 40%. In order for us to understand what we're going to do to break even, we're going to take our fixed expenses divided by the contribution margin ratio to figure that out. However, I'm getting ahead of myself here, so let's go back. The variable expense ratio then is the complement to the contribution margin ratio because it's going to take the variable expense dollars divided by total dollars to get this ratio right here, 60%. So you see that calculation here? We can do it either way. We can look at total dollars or per unit dollars. Either way, we get the same percentage. I wouldn't worry too much about this formula down here unless you're just really into the math of this. But the contribution margin is the complement of the variable expense ratio. So you could also say it's 1 minus the variable expense ratio. Although I think that's just a little bit more than what I would even worry about. If I were saying the contribution margin ratio formula you need to know, it would be this one. CM ratio is equal to contribution margin over sales. And if you want to write out what the contribution margin is here, that would be a good idea as well. So when we apply the contribution margin ratio, we're actually looking for the amount of sales that we need to break even and perhaps the amount of sales that we need in order to make a specific profit, a target profit. So here's what we have. We have different levels of sales volumes. We have a present, expected, and what the increase is. So the profit is the contribution margin ratio times sales minus fixed expenses. And the change in profit is the CM ratio, contribution margin ratio, times the change in sales minus the fixed expenses. So the calculation is right there. Now, so here, when we're talking about the profit at a specific level, we can actually calculate that using contribution margin ratio. and the sales that we have, the fixed expenses we know. They've calculated what it would be if we're selling 130,000. We'd have a profit of 17,000 right here. So basically, one of the big advantages of CVP analysis, or cost volume profit analysis, is that you can plot out at different levels and different scenarios exactly what kind of net profit you'll have, or what kind of net operating income you expect to have. And so you can look at those and analyze them and make a decision on marketing strategy, product mix, and so on. So we look at here, for example, they have a present month where they have 400 speakers being sold in a month. They have a per unit price of $250, variable cost of $150, and a contribution margin of $100. With 400 speakers in a month, they're going to make a profit of $5,000. Now, what happens? Well, they're looking at a different scenario here. What if we drop the price per unit by $20, and then we sell 200 units more? What's that going to do to our profit? But in order to do that, we're going to have to include an advertising budget of $15,000. So what they do is they increase the sales to $138,000 based on the units that they sold, 600 units times 230. The variable expenses then will be 600 units times 150, or 90,000. We get a contribution margin of 48,000, but we have to take out the fixed expenses that we started with of 35,000, but we add in the advertising cost of 15, so we wind up with a loss. When we look at that, we may look at another scenario. What if we sell, instead of 400 speakers, 460? Well, if we do that, we're going to go from the 5,000 operating net income to 10,100. We're not changing the price here, but we are increasing the variable cost per unit. So here you see a change in the variable cost per unit, $15 per unit. So you have $75.9 in total variable costs, and instead of $100 per unit contribution margin, you now have an $85 per unit contribution margin. However, you've also reduced fixed expenses from $35,000 to $29,000. So when you look at this, the cost volume profit analysis allows us to do different scenario calculations to see exactly what will happen in different situations, and basically to plan for different possibilities. The break-even analysis, like I said earlier, is going to, if we're looking at units that we want to sell, we take the fixed expenses divided by the per unit contribution margin, which is going to be a dollar figure. So in this case, we had fixed expenses of $35,000, contribution margin per unit of 100, so we have to sell 350 units. If we're going to do it in dollar sales, instead of using the per unit cost, instead of doing that, we're going to look at the contribution margin ratio. We're going to take the fixed cost divided by the ratio, and that'll give us the dollar sales we need to break even. Okay, one of the other things that we will want to use this calculation for is to do a target profit. And a target profit is one of those things where you say, okay, look, I'd like to make this much money in the business. Well, how do you actually calculate what you have to sell to do that? Well, we modify the break-even analysis by adding the desired target profit we want to the fixed expenses that we have in the month, and then divide that by the contribution margin per unit to get the unit sales, or the ratio to get the dollar sales. So here we have the unit contribution margin. We get the number of units we want to sell, or if we do it divided by the ratio, contribution margin ratio, we get the total sales in dollars, which is 187,500. Okay, so those dollar sales that we need to obtain a target profit of $40,000 is 187,500. And that's how we would calculate it. Margin of safety is calculated in dollars, and it's basically the difference between the sales that you have and the break-even point. So the margin of safety in dollars is what your total sales or actual, either budgeted or actual, are minus the break-even sales amount that you have. So if you're looking at a margin of safety percentage, you take that margin of safety in dollars divided by the total budgeted or actual sales in dollars. In this case, they show sales of 100,000. The break-even dollar sales for 350 speakers is 87.5. The margin of safety in dollars is 12,500, and if we divide 12,500 by 100,000, 12,500 by 100,000, we get a margin of safety percentage of 12.5%. So those are some issues that we need to think about, or how the calculations are used. One of the things that we need to think about, we can use cost volume profit analysis to do, is to decide what is the best approach to our cost structure. Would it be better to have a high level of variable costs and low fixed costs, or the opposite? Which one would give us the better result? Well, and here you have two different businesses operating with two different cost structures. Bogside has high variable expenses. Sterling Farm has low variable expenses. And then Bogside has low fixed, while Sterling Farm has high fixed expenses. And when they ask you which of these have the better cost structure, well, it depends. It depends on a lot of different situations, or a lot of different variables. But we're looking at really what we would look at here if we were doing cost volume profit analysis. We'd look at which contribution margin percentage is higher, or which contribution margin is higher. And in this case, the Sterling Farm has a higher contribution margin per unit sold. So again, what that would mean is, by increasing sales by a little bit, you would increase profit even more, because you have a higher contribution margin ratio and a higher contribution margin per unit sold. So it would take fewer units to increase your profit, net operating profit. Operating leverage is something that we talked about in class 2. When we talk about operating leverage, what we're talking about is the relationship, which is what I was just talking about, between contribution margin and net operating income. And in this case, when we look at the two side by side, Sterling Farm has a much higher contribution margin ratio, therefore it has a higher degree of operating leverage than Bogside Farm does. What that means is that if you bump up Sterling Farm's sales by a little bit, their profit will increase by a higher margin than if you increase the Bogside Farm sales by the same amount. Basically, what you're looking for when you see increasing contribution margin, you're basically you're thinking about, okay, what will these sales be in the future? If they'll be higher than this amount, the higher the contribution margin ratio, the better. So if you're going to increase sales above the $100,000 level, a higher degree of contribution margin will give you higher net profit right away. Okay, we talk about sales mix. Generally, when we're talking about sales mix and break-even analysis, we're looking at multiple product lines in a particular business and deciding how that product mix changes the break-even analysis. So should we sell different levels of different products, what will be the break-even point? Again, we see some of these different possibilities here. Remember, what you're going to do with these multiple product lines is you're going to look at the variable expenses compared to the sales, and you're going to have a contribution margin for each product line, but you're not going to have a total fixed expense for each product line. Instead, you're going to have a total, and this total fixed expenses can be allocated back to these different product lines based on their contribution margin, units sold, or whatever you're going to use to calculate it on. But you will not have fixed expenses on each of these product lines. Instead, what you're going to look at here, and this is what they're looking at right here, is what are these sales they're going to have. Well, you have a 20% of sales here, 80% here, which means that when we get to the break-even point, you're going to have this amount times 20% to give you 12,000, this amount times 80% to give you 48,000. This is the overall break-even point, and that's how they calculate it, because you are calculating it based on the ratio of units sold for each product line. And that's the way you do break-even point for multiple product businesses. I hope this helps, and again, I can't wait to see everybody back in class, but we'll be looking forward to Chapter 6 and 7 and moving ahead.